was, in the immediate terms, triggered by the financial crisis. Now, that means the collapse of the banking system that began with the subprime mortgage collapse, but spread to other sections of the banking system, was the trigger. Now, as I tried to show, that was rooted into a much longer term, deeper trend in capitalism. But if we look at it from the point of view of the immediate crisis or the conjuncture of capitalism, it was the finance sector that triggered it. And for instance, Marx in the 19th century referred to exceptional occasions when this would happen. That it was usually the other way around, that a decline in production or a sudden development of overproduction then leading to a slump or a downturn for various reasons in the real economy, then led to a financial crisis. This was the other way around. And what had happened is that the whole edifice of credit had become so overblown and so contradictory that in effect it collapsed under its own weight. Now obviously there are specific features. You can say that the policies of various investment banks, the policies of big mortgage lenders like Fannie Mae and Freddie Mac in the US and some of the big mortgage lenders in Britain all contributed to the situation, but basically they were a product of this dominance of finance capital and this massive reliance on credit and manipulation of credit. Now, the first thing that bankers used to learn in the good old days, whenever they were, is that the main problem with banking was assessing credit risk. So bankers who wanted to survive and make money used to check out their customers or borrowers and check their credit worthiness, their income, their assets, their credit record, and so on and so forth. But of course all that tended to go by the board in the late 90s and the early part of this century. But the financiers thought, well, no problem, because we've got ways of dealing with this, and they invented these things called credit derivatives, which were supposed to abolish risk. Now, a derivative is basically a contract. In the past, they were used for things like commodities, like wheat or oil, and they allowed people who wanted oil or wheat or whatever next year or 2 years' time to actually contract to buy it at a future date at a set price. So it eliminated, it was a gamble, but it eliminated the risk. They knew how much they were going to have to pay in a year's time or 2 years' time. But then we got the removal or the step up of the credit, the derivative from real commodities, where the derivative is called derivative because its value is derived from the underlying asset. Well, the underlying asset was originally, as I said, a commodity, or it could be a building or whatever. But then they developed a new layer of derivatives that were related to financial assets, like, for instance, mortgages. And that's where the subprime crisis came in, because they packaged, the mortgages were not just one customer, one bank, or one building society, but banks and building societies and various other agencies would take out mortgages, but then they would sell them on to investment banks or other institutions. They would chop them all up into little pieces and bundle them up into bundles. This is, simplifying version, obviously, but it's basically what happened. And the idea was that if one or the other, or one group of borrowers defaulted, then it wouldn't really matter, because there were so many others who wouldn't default at that time that it would balance itself out. So they almost convinced themselves that they'd abolish risk, that there was no more risk in lending money. So all these mortgages, which were, for instance, in the US, they started in cities like Detroit, which is one of the poorest cities in Detroit, with historic high levels of unemployment. And they deliberately went out to sell these subprime mortgages to people in those areas. And it wasn't an accident. They actually needed those mortgages because as they were high risk, they also bore a high interest rate. So they provided the high interest rate component of these packages of mortgages. Now, if somebody was a surefire borrower who had good assets and a good credit record, they wouldn't attract such a high interest rate because there's very little risk attached to them anyway. So they actually promoted risky loans in order to push up the interest rates on the grounds that it would all be cancelled out by the mix in these packages of credit derivatives. And then they had other forms of derivatives like so-called credit default swaps, which are very complex things, but they basically were supposed to act as some kind of insurance. So if people or borrowers defaulted, then from the pool of people buying these default swaps, they would be paid out. So it would act like a kind of insurance fund for the investors. But instead of abolishing the risk involved, it actually turned out to maximise it, because what they found is, in the end of 2007, is that the so-called toxic elements, the elements that had defaulted and were no longer producing any money, had become so mixed in with all the rest that nobody knew what was contaminated or not. They didn't know whether the bundle was good or there was a 10% bad element or 20% bad element, so no one would buy them. And then the people who bought these derivatives on the basis of credit had their creditors demanding that they pay back their money because they were worried that they no longer had any assets and so on. So basically it was like a bank run, except it wasn't like the bank run of Northern Rock where people are sitting outside, or the Cheltenham and Gloucester, where the local savers are sitting outside the bank demanding their money. But it was like a much bigger bank run of the big investment banks all demanding from one another that they all return their loans or cough up their collateral or whatever. And that is what led to the meltdown and the virtual disappearance of all the major investment banks. They were the dominant form of the finance sector for 15 or 20 years. And then after 2007, 2008 and the collapse of Lehman's, they've all been bought up by the big major banks. There's no independent investment banks now, and that shows the extent of the collapse. Now, as I mentioned at the outset, the crisis of the banking sector led to a credit squeeze, so the banks were no longer willing to lend to anybody, even one another, and the so-called interbank lending network, which was previously being used for the banks to lend to one another to cover their day-to-day business, completely seized up.